All right, good afternoon, everyone. I think it's time that we get started here. So thank you, everybody, for joining the second part of our business owner educational tract. My name is Kieran Leva. I'm a senior financial consultant and partner at Senecal Lyons and Associates Private Wealth Management. Our family office provides comprehensive and complete financial planning services to successful business owners and professionals, as well as to high net worth families with complex financial planning needs. We regularly produce presentations and webinars that address specific aspects of family office and financial planning and asset management services. The Business Owner Educational Tract is designed to provide timely and important insights to help business owners and professionals grow and keep their family wealth. The second installment in this series and today's presentation aims to highlight important aspects of tax-effective investing through your corporation with the aim of getting more money out of your company and into your pocket. So a couple of notes before we begin. Our presentations are interactive in nature, so we do encourage you to use the Q&A function on your screen if you do have any questions throughout the presentation. We'll get to as many questions as we can at the end of the presentation. If we can't get to yours, if there's a lot of questions at the end, if the questions are more general in nature, we'll respond not only to you, but to all the attendees if we feel the answer can be of value. If the questions are more specific to your specific situation, we'll respond to you directly. Finally, a bit of a disclaimer here. The contents of today's presentation are meant to be conceptual in nature and aren't to be taken as advice. Everybody's situation is unique and personal to them, particularly when it involves corporations. So any of the strategies outlined today would need to be considered in the context of your individual circumstances and may not apply based on the particulars. Okay, so these are the topics that we'll be reviewing this afternoon. After a quick recap of our first session in the series, we'll be jumping into the most important tax considerations when it comes to investing through your corporation and eventually get your wealth out of your company and into your pockets. So every one of these items could be the subject of a presentation in and of themselves, but we're going to be trying to keep this relatively high level today. You can tell from the itinerary here that tax planning and is a very important part of what we do, not only for clients on an individual level, but particularly when it comes to the corporation and corporate tax planning. So presenting the second installment of the Business Owner Educational Tract is Pierre Senecal, Executive Financial Consultant and Senior Partner at Senecal Lyons and Associates. Pierre has years of experience as a business owner in the field of manufacturing, land development, construction, and international trade and finance. Pierre specializes in providing advice on financial, tax, and estate matters to high net worth business owners and professionals. So in addition to being a chartered professional accountant, Pierre holds many other industry-leading designations, making him one of the top financial planners in the industry. So without further ado, let's bring in Pierre for a recap of the previous session, and he'll also be going over the body of the presentation for you guys today. So Pierre, please take it away.
Thank you, Kieran, and hello, everyone. Thanks for tuning in. Let's quickly review some of the relevant points we made in our first session a few months ago. First thing we looked at is why people should or would incorporate. And at the end of the day, creating the corporation and maintaining it has costs. So you would only want to incorporate if it makes some sort of financial sense. Generally, people incorporate because they make more profits in their business than they need to live on. So it makes sense to leave the money in the corporation at a lower tax rate than taking it yourself at the higher tax bracket. There are also some personal expenses, and we'll get into that later, that could be paid by the corporation. So it makes sense to use a corporation for that and pay for the expenses again at a lower tax rate. And finally, a lot of people may not get those benefits, but to avoid personal liability or in construction or something, then it makes sense to incorporate to make sure that if something goes wrong, you don't get sued personally and lose your house over it. We then discussed the different stages of a corporation, from startup to transition, or the sale of your company, if you want. And each stage has a different set of complexities for the owners or shareholders. We help business owners make the right decisions at the right time with the right partners to ensure long-term success of the business, the owners, and their families. Finally, we talked about a bit about the tax benefits of corporation, and in a nutshell, tax deferral is one of the big ones. It would basically mean right now you don't need the money, just pay a lower tax rate, and then later on, when you need it to live on in retirement or whenever, then you can take it out at a higher tax rate, and you can even, if you manage your personal tax brackets, take it out at a lower rate than you would have otherwise. So it might be tax savings also. Another benefit is, in some cases, within certain rules, you can actually income split with members of your family. And one of the other big elements, when it's possible, is that you might be able to, when it comes to selling your business, to sell the shares of your company and avoid the tax on the capital gains on the shares if you meet the criteria we talked about in our previous presentation. Just to give you an idea what that means, we talked about this. If you were to sell the assets of your business rather than the shares of your business, well, the assets, a $4 million business in this example, 39% of the $4 million would be lost to tax if you sold the assets by the time it hits your pocket. Whereas if you sold the shares, only 25% would go to the government, so you keep the 75%. And if you can benefit from the what we call the capital gains exemption on the sale of shares, and you can multiply that. You can basically bring it down to 0% to the government. So a lot of planning there. When you do that, we often, with our clients, talk about what kind of structure they might want to use if it makes sense. Now, in this example here, and we do this 3-4 times a year with our clients, we help spearhead this. Business owners has an operating company. We suggest that they do what we call an estate share and basically exchange their common shares of the corporation for preferred shares in a tax effective way, and then create a family trust and a holding company, issue all the common shares, because you've exchanged your common shares, there are no more common shares. So then you would turn around and issue new common shares of the operating company to the trust, and the beneficiaries of the trust are you, your spouse, your families, your kids, your parents, whoever you want, and a holding company. Now, all the dividends would go from the operating company to the trust, and then the trust would decide to reassign them, typically to the holding company on a tax-free basis. When you actually eventually sell the company, there'd be capital gains potentially on the common shares that the trust would then allocate to you, your spouse, your kids, whatever. And for everyone they assign it to, you can get up to, at this point, $1.25 million of free capital gains, or tax-free capital gains. So definitely a good planning situation at that point. And more pertinent to what we're going to talk about today, we like to compare the taxation of money if you keep it in the company rather than if you pay it to yourself. So in the example of $1,000 of business profits, if you were to pay it to yourself as a bonus or a salary, you would end up at the highest tax rate, paying up to $535 on that $1,000. So you have $465 left in your pocket to invest, pay for your expenses or whatever. If you decide not to pay it out to yourself as a salary, but keep it in the company, then the company would have to pay taxes. In the first scenario, it didn't. Only you paid the taxes. But in this scenario, the company pays 12.2% in Ontario. That leaves you $878 instead of $465 to invest, pay for expenses, or whatever. So for a lot of people, leaving the money in the corporation is actually a very good calculation. Finally, the last things we talked about issues like tax on split income, which is a sort of a new thing in the last few years. We talked about the small business deduction grind, where if you have too much investment income in your corporation, you might end up paying more taxes on your corporate profit. We'll get into that a bit later. And finally, we talked about the potential triple taxation at death, where in this example, we had a $4 million company that if you didn't do any planning, you can end up with, from the 4 million, 1.3 or 1.4 million in the estate's pocket instead of the 4 million, meaning that 2/3 of the value of the company ends up in the government's hand. Planning that has to be done, and we talked about that in our first session. Now, let's talk about going to the meat of today's presentation. Let's explore, tried and true tax-effective investment strategies for you and your corporation, because at the end of the day, our goal here is to get more money in your pocket tax effectively. So let's start with this first important concept that we have to understand when we look at the corporation. So you and your corporation are two separate entities that are really separated by a thick wall. Now, to get money out of your corporation and into your pockets, assuming you haven't loaned money to your corporation that you're simply repaying you, or you have the opportunity to pay yourself a tax-free dividend, we'll get into that a bit later. You have to pay taxes when money goes from your corporation to you. If it's a dividend, it could be up to 47, 48%. If it's a salary, it could be, depending on your tax bracket, up to 51%. And with that money you receive, you pay for your lifestyle, your house, your groceries, etc. But there are some lifestyle assets that could be paid by the corporation. So rather than transfer the money to you and pay the high taxes, you might have some of those expenses, if it makes sense, paid by your corporation with that $878 instead of the $546 we talked about. Even part of them, like disability insurance, critical illness, health and dental expenses, could actually be tax deductible to the corporation. So not taxable to you, tax deductible for the corporation. So again, every situation is different, but it's something we look at. So if you leave the money in the corporation, next thing you'll want to do is invest the funds in your corporation. You don't want to leave them just in the bank and collecting nothing. So investing money through the corporation has a downfall. The tax rate on investment profits or income, if you want, is 50.17%. One of the things we'll be talking about today is how to avoid that as best you can by investing in a tax efficient portfolio. And we'll explain what that means a bit later on, but there are ways to invest your funds and minimize the tax consequences inside the corporation and even in your pocket. So typically we have part of our portfolio we build for clients in the tax efficient portfolio. And funny enough, life insurance as an asset class. So some people, obviously you need life insurance, but some people want life insurance because it's a very tax effective way of investing your money. So we typically put part of our portfolio into a life insurance. I'll explain how that works, and part in a investment portfolio. And at the end of the day, while you're working or in retirement, you can turn around and pay yourself tax preferred dividends, because you pay a lower tax rate on dividends than you do on salary or bonus. And in some cases, you can even get tax-free dividends out of that. So there are ways to get money out of your corporation with a good portfolio of stocks, bonds, and life insurance and other things, and just get tax effective dollars out. So a quick recap here on corporate taxes. When you have a profit in your corporation for every dollar is taxed at 26.5% in Ontario. Now, to encourage and support small business, the government has installed, and it's province by province, the numbers are different, but in Ontario, typically your first $500,000 of business profit, and I insist on the word business profits, are taxed at 12.2%. Now, that first 500,000, we'll get into it. We got into it in the first scenario. That 500,000 could shrink if you have too much passive income. So if you have more than $150,000 of investment income in your corporation, taxable investment income, then that 12.2% finally disappears and you pay 26.5% on everything. By the time it hits your pocket, the 26.5% dividend tax rate on your profits plus the tax rate on the dividends you pay yourself comes to about the same tax rate as a 12.2% plus the tax on the dividends you pay yourself. So again, it's just a question of tax deferral. You prefer to pay your tax later rather than sooner. Income, so passive income, which is investment income, taxable investment income is taxed at 50%. Now, when you pay a dividend out of those profits to the shareholders, the government refunds part of those taxes to the corporation. So end up at the end of the day, you pay just under 20% tax on the profits of the corporation by the time you issue a dividend out. And if your dividend is from, if you actually, your income comes from dividends from publicly traded companies like Bell Canada, Enbridge, or something like that, then by the time you pay yourself a dividend out, the tax rate for the corporation is more like 0%. And one final thing is when you issue a dividend from what we call safe income, so from profits from your operating company to a connected holding company, your tax rate is 0%. So in essence, you're just transferring the after-tax profits from your operating company, taking it out and sending it to your holding company to safeguard it from creditors. Now, another last important concept we want to talk about is you may have heard about the capital dividend account. Your accountant may have talked about that. And that, in essence, is not something you would necessarily see in your financial statements. It's basically the government keeping track of what they call capital dividends, an amount you can issue as a capital dividend. A capital dividend is a tax-free dividend. So if you have any money accounted for by the government in your capital dividend account, you can issue for that amount a tax-free dividend to whoever, whatever shareholder you want. Now, it's a notional account, and basically it comes from the principle that what the government wants to do is whether you invest through your corporation, this is the principle, whether you invest through your corporation or directly in your pocket, by the time the money you invested in the corporation hits your pocket, you should have paid the same amount of tax between what the corporation pays and you pay at a lower rate versus if you paid the higher rate personally. At the end of the day, if you invest $1,000 and you through the corporation, you end up with 600 in your pocket. If you had invested personally, that $1,000 would have given you 600 in your pocket. That's a principle. Not perfect, but that's sort of what they want to do. So the capital dividend account is just to recognize that if ever the corporation receives a tax-free income that would have been tax-free to you. So for example, you may know that if you have capital gains, half of the capital gains is taxable, half is not. The non-taxable part, the corporation doesn't pay tax on it. That populates and increases the capital dividend account, and the corporation could issue a tax-free dividend to you. So that tax-free portion of your capital gains, whether it's earned in the corporation or you personally, you don't pay tax on. That's the whole principle here. The other thing that populates that is the death benefits from life insurance policies. Life insurance policy benefits are tax-free to the corporation, and most, if not all of that, could be subject to a tax-free dividend from the corporation to the shareholder or the estate or whatever. So let's talk about tax-effective corporate investing. Now, there are two major ways I spoke of investing tax effectively. One is to have a tax-effective investment portfolio, stocks, bonds, cash, other alternative investments. That's one way. And the other part is through life insurance that I'll get into here. So when we build a portfolio for our corporate clients, we look at the same criteria we would to start off, if we were to build a portfolio for you. So we look at, your time horizon. How long is the money expected to stay there? We look at your capacity to take risk. Some people want to take risk, but really they can't afford it. So we look at that. And the other thing is how you tolerate risk. Some people have the financial capacity to take on risk, but they can't sleep at night. So we don't take risk. So we look at all that when we build a portfolio for a corporation. We look at diversification. We look at everything we need to. The added element, though, for corporations is the tax element. Different investments are taxed differently, and from there you get a different amount of taxes payable by the corporation, and then when you dividend it out to you, you have a different, you have to pay tax on the dividend. So what we did here is we looked at four different, and there are more, but let's start with the four different types of, or the five rather, different types of income you can get through your normal investment account. You get interest income. So in each case, we said what happens if you get $1,000 of taxable of income. So Interest income, the corporation ends up paying 20%, I said, so $200 in taxes, which leaves $800 for money left over for a dividend to yourself, which means after you're at the top rate, if you were to pay that 44% tax rate on those dividends, so 352, which means that in your pocket, after the corporation's paid $200 and you've paid 352, there's $448 left in your pocket. It's not the worst. The worst is if you get a foreign dividends or a dividend from Home Depot or AT&T or whatever, an American dividend. Well, because of withholding taxes and all that, you end up paying more money in the corporation, and that leaves less money to pay to you, and you end up paying less personal taxes. But at the end of the day, there's $381. If you were to receive a dividend from Bell Canada or somebody like that, $1,000, corporation would end up paying nothing, so you would have to pay your tax on the eligible dividend at 38%, so that's $620 in your pocket. So a lot better than receiving the same. If you receive a 4% dividend versus a 4% interest rate, you're better off with dividends. Capital gains, that almost changed when they changed the tax rules last year, but they came back on that, so it's not an issue anymore. But basically, because $1,000 of capital gains, 500 taxable, 500 not, so the corporation would end up paying $100 of taxes. You would get $500 tax free and $400 taxable. So the $400 taxable would cost you $176. So you get more money in your pocket than if you were doing anything else. And then if you were just to take cash from your corporation and send it out as a dividend, you'd be paying $440 personally for that, so $560. So sometimes to pay tax as capital gains is not a bad thing when you look at the cost of the money when it gets to your pocket. So anytime we build a portfolio, this is, we want to manage risk and diversification. There'll be some interest, there'll be some dividends, there'll be some capital gains. But we look at that and try and set up a risk managed portfolio that reduces your overall tax rate by the time it hits your pocket. Now, let's look quickly at life insurance as a way to reduce your taxes for your corporation and all kinds of other benefits. And you can call it life insurance. I call it wealth insurance. Really, it's investment grade life insurance as an alternative investment option. So if you permit me here, I'll just step back here and just to explain this concept. When you invest personally, and I'm not talking through the corporation, I'm talking personally. When you invest personally, you will really have 7 personal options for investing when you break it down. You have your RSPs and registered investments, your tax-free savings account, your non-registered, which technical term, just an investment account. The new thing you have right now is first home savings account. You can invest in your home, in real estate, and in an alternative investment option, which I'll get to after. So when you invest in your RSP, you save money as you invest. It grows tax-free, and however you have to take it out, you got to pay taxes. So benefit going in, benefit growing, but not so good coming out. Your tax-free savings account, you don't have any benefit by investing the money in there. However, it grows tax-free and it comes out tax-free. So, all in all, a good investment idea. Non-registered or just investment income, you don't get any benefit from putting the money in. However, as it grows, you might have to pay tax on dividends and interest or whatever, and then there might be tax to be paid in capital gains. So one of the least effective investment plans out there, and the reason we look at tax-free savings accounts and RSPs is just because they give you a tax advantage by investing there. However, RSPs, TFSAs, and first home savings account do have a limit as to what you can put in there, and the limits are rather low. First home savings account, again, beautiful thing. You save money when you put it in, like an RSP. It grows tax-free, but it comes out tax-free when you buy a home. So for most of our clients' kids who don't have a home yet, or our clients who haven't owned a home for the last 5 years, that's a great opportunity. Principal residence, you don't get an advantage for buying it, but the value of your home grows tax-free, and you can sell it and not have to pay tax on the profits there. Real estate, well, again, no advantage investing. You probably have to pay tax on the net rent, and then there's capital gains to be paid. Last thing is obviously life insurance. So life insurance, just like the TFSA or your principal residence, no benefit to investing in there. Grows tax-free, could come out tax-free. So your principal residence, TFSA, and insurance, similar. Your non-registered, your real estate, similar. And then your RSP and your first home savings account are in a class of their own. But again, principal residence, you only get one, and the amount of land you can have included in there is limited. Real estate, non-registered, there's no limits, but everything else, there is a limit. Life insurance, there is a limit, but it's very, very high. And what we find, it's mostly determined by your willingness and capacity to invest in that type of investment. Now, that's for your personal. And I just wanted to bring there as comparison, because for your corporation, you only have three options, really. Your investment income, some people like to invest, your non-registered investment account, real estate, and insurance. And again, you have the same characteristics there. So why would you want to have life insurance in your corporation rather than to hold it personally? Well, the obvious reasons is you're paying your premium with lower tax dollars. So in an example, I would have a life insurance on my life, owned by my corporation, paid by my corporation's after-tax money, and then the corporation would be the beneficiary of my life insurance. So again, $1,000 of income would produce $465 in my pocket to pay for the premium, or $878, so I can get a lot more insurance for that same $1,000. Tax-free death benefit would be paid, obviously, to the corporation. The tax shelter growth inside the corporation, so the part of that investment, you do not have to pay tax on the growth. And because of that, you are not subject to that small business deduction grind. The insurance itself is a great investment because, it only goes up, doesn't go down. If you pay your premium, it cannot go down. It just goes up in terms of investment, and we'll get into the details. And again, when I talk about life insurance or wealth insurance, there are strategies to access the funds, tax advantage or tax effectively, while you're alive. You don't have to wait to die to take the money out. And that's one of the beauties of this. So where does life insurance fits into your portfolio, like we talked about when we said 10 to 25% of your portfolio might be life insurance investments? Well, if you look at the brown part, your normal life insurance, corporate investment portfolio, you have stocks or equities, you have bonds, fixed income, cash, and you can have other types of investments, real estate or whatever. So stocks, they go up and down, and they usually the best of all the public investments, the one that has done the best over time and is expected to do the best, but they fluctuate, they're up and down. Fixed income, call it government bonds, GICs and stuff like that, they don't fluctuate that much, but they don't pay as much as stocks. But typically stocks go up, bonds go down. Hasn't been that true lately, but that's how that works, and it helps you diversify your portfolio. Now, life insurance has a risk structure, if you want, or risk characteristics of government bonds. They don't fluctuate, they barely do. And if anything, they fluctuate upwards. So they're as safe as, or I would even argue safer than, government bonds. Their return rate is typically somewhere nearer to equities, but they don't necessarily have the liquidity that you would have with traditional bonds. So pros and cons, not that liquid, safer than bonds, I would argue, and returns that are not quite, but closer to what you would get in the stock portfolio, but without all the ups and downs and heartaches you might get that way. So we like to look at life insurance as part of your fixed income portfolio, so that fixed income is just dragged on to represented by that circle there. So let me explain a bit how whole life insurance works. So if you were to look at, just contract a whole life policy, make it up, $100,000, $500,000 payout, you would pay the premium. You would get, through the life of your policy, you would get that same amount. So you contract a $100,000 life insurance policy. That base policy would pay out $100,000 when you die. What the government does, a huge part of what you pay for premium is actually investments. Part of it is the premium for the insurance. Another part is investment, and it's calculated in a way that the insurance company guarantees that if you were to cancel the policy, you will get a specific amount of what we call cash surrender value, which basically means that they are creating a fund to make sure that there is money there to pay in case you die. And that fund has guaranteed amounts every year you pay your premium, or or even if you don't need to pay your premium, and that grows and grows. Your $100,000 death benefit does not, but the investment part grows with guaranteed annual amounts. And it's designed so by the time you are 100 years old, if you're still alive, if you have a $100,000 policy, you have a $100,000 cash reserve. And if you cancel the policy, they pay out the cash reserve to you. It's your money. Now, when you pay your premium, typically you don't die right away. So the insurance company has a lot of money that it could invest. And basically, it's your money they invest for you. And they invest it in a very safe way, and they have a way of smoothing out the income over 5 years. So the good years sort of subsidize the bad years, etc. But at the end of the day, every year, and if you think of Canada Life since 1847, has paid a dividend and profits every year, even through the Great Recession and the Great Depression. So what they do every year, they pay a dividend. Now you can say, write me a check for that dividend, which is fine. Or you can say, like most of our clients do, this is nice. Can you reinvest that money and compound it inside this life insurance contract? And the way they do that, they say, sure, we will issue a one premium only life insurance policy. So that dividend will pay premium, and then there's no dividend to be paid on a new policy. So they'll add a policy, an insurance policy on top of that one. And the next year, same thing, and the next year, and the next year. And you'll notice that this is on purpose. They get bigger and bigger because the dividend goes up every year. They can buy more insurance. Beauty of this, every one of them is a whole life policy, so they all have the policy reserve, and they all add up. So another way to look at that, if I were to just point here for a sec, you see that the amount of life insurance goes up faster and faster. If I were to replace that instead with just one life insurance policy, this is what the death benefit would look like. Faster and faster it grows. So even though you contracted $100,000 worth of policy, the amount of insurance that would pay out gets bigger every year. And if you add up all the cash values that are supporting this, well, you would see that they all add up. And again, at age 100, those two lines meet. So if by this time you get $1 million worth or $500,000 worth of insurance payout by the time you're 100, you could cancel the policy. And at this point, you get $500,000 back. That is the reserve that is yours. You can access. Not necessarily a good thing to do because you don't get the tax-free treatment if you do that. But if you pass away, it is tax-free. Another way I like to look at that is you are guaranteed an amount of dividend every year. Call it the light brown here. And then the investments have always created dividends, probably will for the longest time, if not forever. But the first year you get this dividends, and this year is guaranteed not to go down as long as you pay the minimum premiums. So the green part represents a previous year dividends that will not go down. And then to that, they add the next year's dividend, and that becomes the minimum for the next year. So again, if I were to point, this is the minimum for the third year, and then you add the third year dividends, and then you have the new minimum, and then it grows from there. Now, this is sort of misleading because you see, because you're getting bigger and bigger dividends, the brown and the two brown ones actually get bigger every year, but we didn't necessarily show that here. If you compare to investment in the stock market, for example, well, you get a lot of ups and downs, sometimes crashes and all that. So you would get as good, if not better, a return potentially, but with the risk associated. And we're comparing this to a risk-free or a lot risk-less policy. So let's look at a quick example here. So we ran last year an illustration for a 50-year-old male non-smoker, and we say, hey, we were going to issue a $500,000 whole life policy that you pay till you're 90, so 40 years of payment potentially. But we're only going to invest, premiums are 30,000. We're going to invest that only for 10 years. And why 10 years? Because somewhere after 7 or 8 years, you hit a critical mass where there's so much money in your cash value that you can stop paying your premiums, and it generates more than enough profits every year to pay for the premium and keep on growing. So the red line here shows the accumulated amount of dividends you'd be paying, and then you stop paying. So I should have continued the red lines all the way here, but you're not paying anymore. The blue line is the amount of insurance that would be paid out at death, and you see that it flattens out, goes down a bit here because you stop paying your premium, so it stops growing initially, but it still grows, and at some point, the profits represented by the investments in the green line are getting bigger and bigger, and eventually your amount of insurance keeps on growing again. You'll notice that the amount of green line after about 8 years are worth as much as you put in, and then the investments are worth more than you put in, and they keep on growing even though you're not putting any money in it. If I were to compare that to a $30,000 a year investment in GICs, because you know what? Why GICs? Because it's the only thing that is almost as safe as this insurance. So I don't want to compare this to anything but a fixed income bond or something. So if you were able to get 5% a year on a GIC for life, and good luck with that, because you can't find that today. But if you were able to, and you were to invest that in the corporation, and then when you die, take the money out and issue a dividend to the estate, the blue line would be showing $30,000 a year, so $300,000 investment, and this is what the life insurance would pay out net to the estate. The dark blue line would be your cash value that we talked about, so at some point it grows tax-free, so it grows faster. And this is the after-tax value of your $30,000 a year. So we calculated you need 9 or 10% every year interest on your corporate investment to sort of give the same thing you have here. For those of you who, like me, prefer numbers, so in the first year you invest 30,000 in the red part here in the GIC at 5%, pay your taxes. This is what's left over. If you had died then and dividended out, the company gets this back from the government. So there's amount of 31,208 dividend taxable, call it the highest rate. This is the amount that would be in the estate's pocket. The same year, if you had died at the end of the year, this is the amount that would be in the estate's pocket for the insurance. Obviously, you just paid one premium, so it's that much better. After 10 years, you would have invested $300,000 in your GICs. This is the annual interest at 5% of what's left over. This is what the year-end value would be. Add the refundable tax that the government, that 30% that the government pays you back. This would have been the dividend. After tax, the estate would get just under $200,000 after 10 years. After investing $300,000. It would get $980,000 from the insurance proceeds. And, if by the time you're 85, you pass away, the corporation would leave $441,000 after tax in the estate versus almost $1.5 million from the insurance. So again, great investment to get money out tax-free from the corporation, better than any equivalent investment you can make. And at some point, you can actually access those funds while you're alive. So it's not like you're giving up access to these funds at all. So sort of a last word here I wanted to talk about. Again, you can access the cash surrender value, that money you would get, that reserve, you can access that while you're alive through the corporation. And there are many ways of doing that. And every situation is different. And obviously it's something we work with our clients to try and figure out if it works for them and what works for them. But you can basically surrender the policy saying, I want to cancel my insurance and take that money out. You can do that. There may be tax consequences, but you can do that. You can only redeem part of the cash surrender value if it makes tax sense. You can always do that. You can say, at any time, you can say, listen, rather than reinvest the annual dividend, just write me a check every year. Yeah, you can do that too. With a lot of corporations, we do what we call immediate financing arrangement. And that's basically when people have lots of money stuck in a corporation and they want to find a way to be able at some point to take the money out. But on the other hand, they don't want to, they don't want to pay. So we had, for example, what we can do, you can borrow against the cash surrender value with the insurance company or another bank easily, where because of the guaranteed aspects of there, we had a client who had $2 million stuck in their corporation. So we made a plan where they put $400,000 a year for 5 years to take that money and put it into the life insurance. But after the first year, they put in 400, they can borrow 300, 350 against it. And after 3 years, 3 years, they put in 1.2 million of the 2 million, but they can borrow more than 1.2 million. And by the time the $2 million is in life insurance, they can turn around and borrow from against that policy and, buy the building or invest in their company, do what they need to do. But they still have the same cash availability. But on the other hand, when the time comes, they'll be able to take that money out tax-free and substantial amount because, 2 million of premiums pays for a lot more than 2 million of life insurance. So in a nutshell, that's sort of what we wanted to talk about today. Obviously, there will be seminars in November. I think we're having a seminar on just focused on the life insurance. So we'll get a lot deeper into all these strategies. So it might be something to listen to. We have others that sort of pertain to this on estate planning and all that. So that was my presentation for today. Hope you learned a few tidbits in there. I'll now pass it on to James to wrap this up.
Excellent. Well, thanks for the wealth of knowledge there, Pierre. Certainly a lot of information to unpack. I expect we'll have a variety of different questions here. So while we sort through those, I just wanted to take a moment to talk about our team and the services that we provide to our clients. And it's a friendly reminder, more than happy to address any questions that are general in nature. If you have a question that is specific to your circumstances, please do reach out to us and we'll be happy to address that independently. So you'll see a picture of our team here. Of course, we've met Kieran and Pierre. We also have the client servicing team here. We've assembled a highly qualified team to serve the needs of our clientele. Kieran, Pierre, and I are all certified financial planners and work together to provide the best advisory services possible. And we're supported by our amazing client servicing team. Can I get a slide, please? Excellent. So I wanted to take a quick moment just to talk about the services we provide and how we work alongside our clients. In a nutshell, our team focuses on working with our clients in the development, implementation, and monitoring of financial plans for them, their families, and their businesses. That being said, one of the core principles of our family office is that financial planning should be comprehensive and consider the various relevant factors of your financial plan in conjunction with each other. Your business financial plans, your investments, your personal financial plans are not prepared in a vacuum. Rather, each depends on the success of the other elements, and we want to focus on ensuring that all the aspects are working in conjunction with each other. For example, you could have the best investment plan in the world. That being said, if that plan is not harmonized with your willingness and ability to take on risk, not synchronized with your tax minimization strategies, whatever the case might be, if all of those things aren't looked at together, the overall efficacy of your financial plan may be impacted. So as we work with our clients, we take the time to understand the variety of factors that may or do play a part in your financial plan, whether that's, again, managing the cash flow of your business, preparing for unexpected events, maybe bringing on a partner, buying new equipment, managing the risks of the business. Maybe it's selling or transitioning out of the business, We work with our clients to ensure that we understand how each factor impacts the other factors to ensure a cohesive plan that creates certainty in all areas of your financial life. So with that in mind, can I get a slide forward here? Just kind of want to talk about how we fit into the picture of your suite of professionals here. Most of our clients do have a number of trusted professional advisors, whether that's their lawyers, their accountants, you name it. It could be their suppliers, their business partners, a variety of people that are involved in their situation. We like to position ourselves as another tool in your tool belt, not looking to take on the role of accountant or lawyer, but rather work alongside you and your already trusted advisors to ensure that all aspects of your financial plans are synchronized with your legal team, your accounting team, so on and so forth. If I could just get a slide back quickly here. One aspect of the way we work with our clients that I wanted to just take time to mention here is that we're not looking to propose strategies that may not be acceptable to your other financial professionals. We want to make sure that there's cohesion within your suite of professionals. So often we work alongside our clients' accountants, our clients' lawyers, so on and so forth, to make sure that there is cohesion with the strategies that we're suggesting do align with their plans as well. And one final aspect I'll just call out here is you'll see on the slide here, we have our in-house specialists. So you've already met our team. One final point I'd like to share is that when you retain our team, you are also accessing the power and resources of IG Private Wealth Management, which means that you're retaining our in-house specialists when you retain us. So that would be all of our specialized tax accountants, estate lawyers, corporate accountants, whatever the case might be. When you retain us, you retain them, and they are at our beck and call, so to speak, when we have complicated situations that might need additional resources. And recently, IG has also added our private company advisory team, which is headed by this gentleman, Dave Turnbull here. So the private company advisory team is a service that's available to our business owner clients who are considering their succession plan in the sale of their business. So you'll see there the variety of services that are provided by the PCA team here. Just to talk about IG Private Wealth Management as a company here, one of the exciting events at IG is that we're approaching our 100th year in business in Canada, 100% Canadian-owned company, and is one of the biggest asset managers in the country. We kind of duke it out with the banks for being one of the biggest asset managers in Canada here. So being under the IG Private Wealth Management banner has provided a variety of resources for our team, which we're happy to bring forward to our clients here. And we're uniquely positioned in Canada. IG is wholly owned by the Power Corporation of Canada, and you'll see that this has partnered us with a variety of the top of the line companies in our industry. You'll see our sister companies, Wealthsimple, Rockefeller Capital Management, also Mackenzie Investments, China AMC, and Northleaf Private Capital, some of our partners here. Having the power of the power company behind us has given us a lot of resources that we're able to partner with these top of the line firms to provide the variety of services and products that our clients need to suit their financial plans here. And just to touch a little bit on the rest of our partners here, typically when we work with our clients, we'll suggest a variety of strategies which may or may not require the implementation of different products. So IG Private Wealth Management has gone out into the marketplace to partner with leaders in their industries to ensure that when we do provide advice that requires products, we're partnered with the best in the business to provide those products. So I'm not going to name them all here, but you'll see some of the biggest asset managers in the world here: JP Morgan, BlackRock, Putnam, PIMCO. On the insurance side of things, we're partnered with the biggest insurance companies in the country. And typically when we work with our business owner clients, there is requirements for debt. So we have our banking partners for mortgages and lines of credit and things like that. Just quickly here, going to talk about our commitment to the community. It's a very important part of our business that we give back to the community. IG has also done that on a national scale. So you'll see here that IG is the named sponsor for the Walk for Alzheimer's and a variety of other good causes in the country. Our team has also made it a core aspect of our business to give back to our local community here in Newmarket. And about 5 years ago, we created our own charitable giving fund through the Strategic Charitable Giving Foundation, which annually grants a portion of our fund to charities in the community. We've created a goal as a team to have a $10 million fund where we're making significant donations to the community each year, and we're working slowly but surely to build the fund up to that level here. So just gathering all the questions here on the side, and you'll see the support team here as well. All right, Pierre, if I can bring you back on here, I got a couple of quick questions for you before we part. So one of the last aspects of the presentation here, Pierre, that we touched on was how to access the cash in a life insurance policy. And you touched on the 5 or 6 different methods that are available to do so. Could you touch on maybe the tax implications of some of those different options and how one option would be taxed versus another option?
Well, yes. Obviously, I mentioned about 5 or 6 ways or more ways than that to access the funds in your corporate insurance contract. One is obviously, like I said, collapse it. If you collapse the life insurance or you cancel it, then you get all the cash back. Part of it representing the amount you've invested minus the cost of the insurance. To simplify things, is tax-free, but any profit, you made profit in there, so there's a tax implication. Corporation has to pay tax on that. And then because you haven't died, there is no tax-free dividend from the corporation to you. Another way to do that is, like I said, if you say, pay the dividend in cash instead of in reinvesting it, then what happens is, until you've reached the amount of your investment, you receive annual amounts tax-free, but then it becomes taxable. And then again, the corporation has to tax it. One of the ways, which is a bit more aggressive, but it works, and a lot of people do that, is they could borrow personally against the value of the cash surrender value that belongs to the corporation. So basically, I'm borrowing personally, and I'm having the corporation assign the policy to the bank. And when I borrow, for example, if I borrow $40,000 a year from the bank and I give the policy as a guarantee, the bank is happy because it knows that that asset's going to grow every year and there's a lot of cash reserve in there, doesn't mind. If I borrow that $40,000, I don't have to pay tax on that. It's not an income. Of course, there's the risk of borrowing and the interest rate risk and all that, but I can do that. I can even have the bank say, just capitalize the interest. I don't want to be bothered with that, or I can pay the interest. But at the end of the day, when I pass away, corporation gets those millions of dollars tax-free, pays a tax-free dividend to the estate, and the estate pays off the debt from the bank. So it's a way for me to access cash tax-free while I'm alive, sort of like getting a bit of that cash or that insurance prepaid tax-free while I'm alive. So again, I can go on and on. There are a lot of different ways of doing that. And it's basically in November, we'll be talking about in detail in our next seminar.
Yeah, absolutely. Thanks for that, Pierre. And I think the overarching message here is there's a variety of different ways to access the cash, and the best way to do so and the tax implications will be, based on the individual circumstances, and we would provide advice accordingly. Keeping an eye on the time here, maybe time for one more quick question. And this is a question that we tend to get every webinar we do, so it's one that I like to throw at you, Pierre, here. But in a nutshell, what are the fees for the services that our team provides?
Oh, well, that's a good question. You're right. We get that pretty much every time. The only fees that we charge, we do not charge specific fees for our services. So if you need an estate plan, you don't get charged for that specifically or anything. The only way we get paid is like any other asset manager. We will charge you an annual fee, paid monthly, but an annual fee based on the amount of assets we're managing for you. For example, if we have between $1 and $3 million of your investments that we're managing, we're charging you an annual fee of 0.9% plus tax a year. If you're over 3 million, then we're charging you 0.75% or whatever. But that is the only fee that you would get from us for any advisory service or any investment management, any life insurance, whatever. That is the fee that you pay, is only based on the assets we're managing for you. So you would pay those directly or indirectly. You'd be paying that to anybody else. The only difference we like to think is you get all the rest of the knowledge and everything for that price.
So thanks for sharing that, Pierre. So I think we're getting close to time here today. So there's a couple of questions we didn't get to. We will reach out and address those on a personal nature after the presentation here today. So thank you, Pierre. Thank you, everyone, for attending. I hope you found value in our presentation today. You will be receiving a correspondence from us about the webinar, just looking for feedback on the presentation. This is an opportunity for you to comment on what you found valuable or what you might want to learn from us in the future. If you did find the presentation today valuable, feedback is helpful for us to know that we're providing information that is desired. And again, if you do have questions, please feel free to reach out to our team. And we look forward to addressing any questions or concerns you might have. Finally, on the screen here, just a note on our upcoming presentations for the rest of 2025 here. We will be, like Pierre mentioned, touching a little bit more on the insurance as an asset class in November here. We also have our philanthropy presentation and our estate administration coming up. So if those are of interest to you, please do feel free to register either at our website, senecalliance.ca, or through our social media platforms, which you'll see here below. With that in mind, again, if you do have questions of a personal nature, feel free to write them on the survey or reach out to us directly, and we'll be happy to get in touch to address those. So again, that will conclude our presentation. Thank you, everyone, for attending. Pierre, Kieran, and everybody that put on the presentation, thank you for your efforts as well, and look forward to seeing you at our next presentation.